Hello and welcome to the Libinance podcast, where history, current trends, and smart investments collide for an exhilarating ride. We'd love to hear from you on what you think, and do follow us on all our social media accounts and leave your feedback as always. I'm Lois Boy, you can call me Libby, and I will be your host for the podcast. For each episode, we embark on a journey through time, explore deep hidden financial histories. From there, we dissect the pulse of today's financial world, breaking down complex trends. But that's not all. We talk about practical investment strategies to empower you on your financial journey. Hey guys, you're welcome back to the Libinance podcast, where we believe the world of finance is for everyone to know. Today's episode is an interview with an investment analyst and professional in the venture capital space. And I don't want to spoil the fun, so let's just get right into it. Guys, today we have a wonderful guest with us, Mr. Miracle Nnaji. Mr. Miracle is a senior investment analyst in the private equity and venture capital space. He is an author and he's about launching his book titled 365 Days in Venture Capital. So it's pretty safe to say you're in good hands with regards to what we have to talk about. Now, I don't want to spoil the fun, so I will let Mr. Miracle go ahead and introduce himself for us. Mr. Miracle, can you take a minute to introduce yourself and share a bit about your background and what drives your passion for venture capital?
All right. Thank you so much for having me on this podcast. It's my pleasure to be here and to discuss a subject that I'm so passionate about, and that is venture capital. So like you rightly mentioned, my name is Miracle Nnaji. And I started off my career as a management consultant, mostly focused on operation strategy, consumer intelligence, and then corporate strategy for clients within from medium to large scale organizations. Now, that was what I did for like the first 3 years of my career. But then along the line, I realized that a lot of times some of the businesses that do not succeed, they don't do so not because they do not have the necessary capacity, they don't have the right strategies, that sometimes it's just that they lack funding in order to be able to grow and succeed. And then at that time, I became more interested in startups, reason being that I see technology startups like critically positioned to leverage the unique creative talents that we have in Africa. So for me, it was more like a decision of, okay, what aspect can I play in that allows me the opportunity to provide both knowledge capital and also funding to these young businesses for them to grow and succeed. And then venture capital presented that sort of intersection that allows me to do these two aspects. And it's one that I'm very, very passionate about. I'm very passionate about supporting businesses. I'm passionate about seeing young entrepreneurs that are trying to solve problems for the Africa economy, being able to receive the right support to do what they are passionate about doing. And for me, that is what drives me. And I see venture capital as a pathway to getting that done. So that's why I'm very passionate about venture capital.
That's very interesting. I think I'm also very passionate about venture capital, but you've made me much more passionate about it.
Wow.
Yes, I really
appreciate that. Yeah.
Yeah, thank you. Now that we've got a sense of your background and your expertise, Mr. Miracle, I'd love to dive into your new book, 365 Days in Venture Capital and VC in Africa as a general. What is it about and what inspired you to write this book? Because I saw on your LinkedIn post, you said venture capital is like the kid next door. People think they know about it, but they don't really know about it. So what is it about?
Awesome. Great question. So the title of the book is 365 Days in Venture Capital, right? And a guide to the business of venture capital in Africa. Now, from the name 365 days, actually, I started working on the book after spending 365 days as a venture capital associate. Now, why did I start writing the book? So two reasons informed my decision to write a book on venture capital. So number one, a critical knowledge gap that I discovered. And then secondly, in order to puts Africa in context when it comes to the practice of venture capital. Now, addressing the first aspect, I transitioned, like I mentioned, in my career from management consulting to venture capital. And that is what we tend to find mostly for most career professionals within the venture capital space currently, that most of them did not start their careers in venture capital. Just a few people are starting their careers in venture capital, let's say fresh out of school, they get into their career as a venture capital analyst. But most people transition either maybe being an entrepreneur or working in a startup, or let's say in other adjacent industries like private equity, investment banking, management consulting. So most professionals from these different fields transition into venture capital. So you see that a bulk of the practices, a bulk of the knowledge that they get to work with is something that they have to just learn on the job, right? Because it's not something that in school we learn about venture capital and all of that. So now that sort of learning on the job can kind of puts a lot of pressure in terms of what somebody has to learn in a short period of time. And that was the case for me, right? That I had to learn a whole lot on the job, and there were so many things I know, the knowledge gap that I needed to cover. So from an outsider perspective, you think that venture capital is just about, okay, investing in startups. But when you come in, you see that there are other aspects like deal sourcing, there's due diligence, then there's also the part of raising from limited partners, and all the different terms and concepts that you need to familiarize yourself with. Now, this can put a lot of pressure in terms of how somebody's learning. And then for me, starting out, I didn't have the privilege of participating in certain venture capital fellowships that currently exist, let's say the Gene VC. And then also, I didn't have that sort of community, right, of other VC analysts, VC associates, and maybe you are stuck in something. You are able to reach out to somebody to say, okay, I'm struggling with ABCD. What are your thoughts about it? So it was more like a Lone Ranger kind of journey for me. Mm-hmm. And for the bulk of other people coming into the space, and also interested in the space, that is also the case, right? Because venture capital is still in its formative years in terms of its application in Africa. In terms of its application in Africa, it's still at that formative year. So that tends to be the case for most people. So that was what now informed the decision to say, okay, let me write a book, right, that somebody can also use as a roadmap to say within your 365 days in venture capital, you should be able to know this. And I was privileged enough to have experienced venture capital from two perspectives, both from the investment side and the fundraising side, because I joined an emerging fund. So that gave me a balanced perspective, which I was able to integrate into the book. And then the second aspect now in terms of putting Africa in context. Now, most of the texts that I interacted with during my first 365 days were based off on certain developed markets like the US. And then when you start applying some of the concepts, you realize that, okay, this particular one doesn't apply like that in Africa. There are certain nuances around its application in Africa that can affect outcomes, right? So many texts did not cover this. And a lot of the literatures are just littered in articles and a few posts that people make on their handles, right? So the need to be able to capture that African context was why I now decided to write the book, so that when we are having case studies and examples, we are not just always hearing Facebook this, Google this, Stripe this, that we're able to use our own African companies as a case. Like 95% of the case studies that I used in the book were based off on African companies. Talk about Paystack, or talk about InstaDeep, talk about 54Gene. So I had to use Africa case study in order to drive the point home. So the need to cover a critical knowledge gap and to put Africa in context informed my decision to write the book 365 Days in Venture Capital.
That's very awesome, particularly because for me, when I found that out, that I really love the venture capital space, I really wanted something, any book at all to help me. I started taking courses and everything. And so I think your book is very, very important, and it would be something very helpful for someone like me wanting to enter into the venture capital space. And so, yeah, thank you. All right.
We'll be very glad to have you.
Yes, I love it. So we're curious. You've talked about the fact that you love the venture capital space. So what is venture capital, and how does it differ from the other forms of investments and ways of financing that we know?
Okay, and great question, and very, very critical, right, to be able to set that particular background. So now, in terms of what is venture capital, now just to keep things very simple. So venture capital is a kind of financing that is provided to startups, early stage young companies that are innovative and has a high growth potential, right? In exchange for an ownership stake in the business. But then venture capital is one that goes beyond just providing financing, but one that also provides value add support. So that through mentorship, through access to network, these young companies are also supported in order to be able to grow and succeed. And then there's one last part is that venture capital is one that within a particular short period of time, whoever provided that financing expects to exit their investment in that particular company for at least 10x of their capital, right? Because to compensate for some of the risk involved in investing, in making venture capital related, providing venture capital related financing. So that's the broad view of venture capital. So the keywords there is that it is provided to early stage companies. It's provided to early stage companies, not just any kind of early stage company, but high growth, right? And has a capacity to grow within a short period of time to provide a huge exit for the person that provided it. And then whoever is providing that sort of finance is not just providing funding alone, but is also bringing in certain value add support that helps the businesses to succeed. Now, in terms of how it differs from other forms of financing, right? I would classify that I would discuss that in three different buckets. Now, the first aspect is in terms of the kind of companies that are being targeted, right? That venture capital is particularly targeting private companies. Private companies, in terms of how, when it comes to the registration of companies, right? You either have a private limited liability company or you have a public limited liability company. So for the public companies, they are listed on stock exchanges. Now, because they are listed on stock exchanges, they can be able to raise capital from the general public, right? Now, we also have another category of companies that are called private companies. Now, these private companies are not listed on the stock exchange, so they cannot raise capital from the stock markets, right? So they now have to turn to other private source of funding. Now, still within that particular aspect, we know that these private companies also exist at different levels of development. We have private companies that are well mature, that have been operational for several years, right? Now, those kind of people can turn to a class of source of funding, which we call traditional private equity firms, that mostly provide capital to private companies that are well established and somehow they've been able to de-risk certain aspects of running the business, right? Now, but then still within the private companies, we have those that are still very early stage, right? That perhaps just 1 year of operations or 2 years of operations. Some of them just have a product. They don't even know how they are going to make money out of it. So those are the kind of companies that venture capital firms are targeting. But then not just any kind of early stage company. So your typical small business that just wants to serve their local community will not qualify for venture capital financing. Why? Because those sort of businesses are not able to achieve high growth within a short period of time, right? And by high growth, not just serving one small market, but also serving an entire country and probably expanding into other countries, like we've seen with some of the startups that we've had in the space. A company like Chilium Health is not just operational in Nigeria, but it's also operational in other countries in Africa. Right. So those are the sort of companies that venture capital firms are looking at. And because technology has provided that pathway to be able to help a company grow very fast, that is why it now looks as if that venture capital majorly invest into technology companies. So firstly is in terms of the target company, the kind of company that venture capital is looking at. Then the second aspect is that is in terms of risk. So venture capital is a high risk investment, right? It's a high risk source of funding. Reason being that for that kind of startup that you are targeting, in fact, statistics has it that over 90% of startups fail. That means if about 10 startups are founded, about 9 of them fail, only one is going to succeed. The sad part is that it is possible that one particular VC invests into those 10 startups and 9 fails, only one eventually succeeds. So you can see that the risk of failure, the risk of losing an entire capital is very, very high. And that is why venture capital comes under more like an alternative investment class for people that are looking to invest, right? So that aspect of high risk due to the failure of startups, that is what differentiates venture capital from other sources of funding. A bank, for instance, would not want to put their money there because they need to see that this loan can be repaid over time. Then the second aspect, again, is in terms of returns. So to complement the high risk involved, there is also the need for high returns, right? That within a short period of time, somebody wants to have at least 10x of their capital. And it's not even abnormal to see certain venture capital firms achieve like 1,000 times of their capital as of when they invested into that particular startup. So the idea behind that high risk high returns is that whatever returns that is made out of the few that eventually succeed makes up for the whole failure from other investment that the venture capital fund or the venture capital firm has made. So to summarize that point, it kind of targets company high risk and high returns aspect of venture capital, differentiates it largely from other forms of capital.
Guys, I told you you were in good hands, and I think I'm not wrong here. Thank you very much, Mr. Miracle.
Yeah, a pleasure.
So you mentioned in the beginning there about that people think venture capital is just about investing in companies, but when you get into it, you get to hear about due diligence and then the other stuff. I'm curious, and I think we're all curious here. If you find a company, or let's say a company comes to you to ask for financing, or if you find a company you want to invest in, is it as simple as just getting or just providing the startup with the money, or is there more to it? Can you walk us through the operations of venture capital firms? How does it work?
Yeah, definitely. Definitely there is more to it, right? Now, I would just like to set the fact that, okay, when it comes to providing venture funding, right? Venture capital, the typical venture capital firms are not the only ones providing venture funding to startups. So angel investors also provide venture funding to startups, right? Mm-hmm. But then one thing that is uniquely different between a venture capital firm from every other kind of guys providing venture funding to startups is in terms of how it is structured. Now, a VC firm doesn't invest its own money into a startup, right? Now, the typical life cycle of a VC fund is like this, that firstly, there is fundraising. So fundraising is that particular point in time whereby the VC is looking for potential investors that is going to invest into the fund. And these investors are people we call limited partners. Now, these limited partners could be high net worth individuals, could be institutions like pension funds, could be institutions like developmental finance institutions, could be family offices, could be sovereign wealth funds. So the universe of limited partners is quite broad. But what the venture capital firm does is that it now acts as an intermediary, that they set up a fund whereby they reach out to these limited partners that put money into that particular fund. Now, out of that fund, that is where the VC now invests. Now, the way a VC is structured is that it's structured as a limited partnership where we have a general partner and then we have a limited partner. So the limited partner is in charge of, takes responsibility for providing the funding needed. Now, the general partner, who is often an expert in sourcing investment opportunities, managing a VC fund, takes up the responsibility of handling all the investment decisions that needs to be made and ensuring that there is a successful exit that ends up paying back the capital to the limited partners. Not just paying back capital, but also giving them returns on their investment to compensate for the risk, right? So the first phase is fundraising. So now let's imagine that fundraising is done. So the venture capital firm now has money to invest into startups. That now kicks a phase which we call the investment phase. So the investment phase is at that particular point in time where the VC is now actively sourcing investment opportunities, like attending events to speak to founders, or let's say referrals from past colleagues, referrals from other VC firms for different investment opportunities. So the typical VC firm may be seeing like 1,000 plus deals in a particular year, but then they don't invest in all of them. In fact, it's as if VCs only do 1 in 300 deals that they review, because the percentage of startup that eventually gets funding is very, very small. So what now leads to a decision on which of this particular startup that we've sourced should we be investing in is what we now call due screening and due diligence. So at the due screening and due diligence level, the VC is now looking at every single investment opportunity that has come into the pipeline to look at what are the risk perspectives to this particular investment, what are the returns perspective involved in this investment. So once all of these different aspects is considered and there is satisfaction, then there is a decision to invest, whereby investment agreements are now drafted and the investment is completed. Okay. Now, after the investment phase, right, the next thing that kicks in is portfolio management. Remember, I said that VCs don't just provide capital, but also provide support in terms of value creation. So portfolio management is where the VC is now monitoring these companies to see how they are performing in order to be able to provide certain support that the business is going to need, maybe access to talent, further fundraising, business development, strategy, all of these aspects. That's what VC does. So after portfolio management period, then we now have exit, where the VC is now actively exiting the startup they have invested into in order to realize returns from them, right? So that's typically what the cycle looks like. And then a typical VC fund is about 10 years. Right, about 10 years, during which they're expected to fully invest and harvest the investments that they have made. And maybe optionally, the fund life can be extended for like 1 year or 2 years, depending on the agreement with the limited partners. So that's in a high level, that's what the operations of venture capital looks like. So the critical aspect of deciding on which investment opportunity to invest into is decided by what comes out of the due diligence process.
That's very deep. That's very deep, and I'm sure it actually goes much deeper. But you just wanted to make this very short for us. Thank you very much for that. In your, I think, third question or so, you were talking about the fact that your book talks more about venture capital in Africa. It looks at companies that you base it more on companies that are in Africa, making it more suitable to investment professionals that are here wanting to transition into venture capital. So I just wanted to know what unique differences are there in terms of venture capital in Africa and then venture capital elsewhere.
I would say the jury is still out there because a lot of conversations has happened around that. Mm-hmm. But to be honest, I don't think that the differences is much around how the concepts and structures of VC is in Africa versus what it is in Silicon Valley. I think to a large extent that the concept and the structures are quite similar. Mm-hmm. That most VCs in Africa are structured as limited partnerships, same way as this is in Silicon Valley, right? And certain concepts around high risk, high returns is still something that is still relevant when it comes to Africa. We still see that sort of high failure rates, right? Both in Africa and then US. But rather, what I think it's about is that there are certain differences in terms of the outcomes of certain approaches to venture capital, right, in Africa compared to Silicon Valley. So that sort of change in approach based upon unique outcomes that we have seen over the years, I think that is one aspect that we need to really pay attention to. And these outcomes are affected by certain unique environmental situations that faces Africa that you do not necessarily all find in the US, right, which is a more established market. Yeah. So let us just set the context for those unique. Again, like I mentioned, the core influence here are certain environmental differences, right, that affect outcomes for VCs in Africa. So let us look at some of those regional contexts with Africa. So the first thing is, I know a lot of times we talk about, okay, Africa startups has raised this number of funding. Africa is going to do this. Africa is going to do that. And to an outside observer, it sounds as if Africa is one big family, right? Mm-hmm. But the truth is, Africa is not one big family, right? Yeah. Africa is made up of 54 different countries. And now these 54 different countries have their own unique economic realities, have their own unique political realities, right? Have their own unique demographic realities that kind of affects, that creates this sort of fragmentation in terms of how the space is structured. And also affects the fact that certain innovations that may succeed in Ghana, if we take it to, let's say, Kenya, is going to fail woefully, right? Because of those unique cultural and social differences. So that's one regional context that everybody looking to practice venture capital in Africa has to take cognizance of. Then the second aspect is also in terms of development. Development is uneven in Africa, right? So yes, Africa is considered a third world country, but it's a third world continent rather. But when it comes to that aspect, to all fingers are not equal, right? That we have some people have better economies, have better infrastructures than others. And that also explains why we have more concentration of venture capital activities in four main countries, which we now call the big four African countries. That is Nigeria, South Africa, Egypt, and Kenya. Right, together they have attracted over 70% of entire funding that has entered into the space. Right, although it has been coming down based off on new markets that are opening up. So that's in another context that affects outcomes. Then the third aspect also that is very critical is in terms of purchasing power. Right, that over 85% of African households spends less than $5 per day. So with this low purchasing power, it also puts a kind of a cap, or it puts some sort of limitations in terms of revenues that certain business innovations can be able to generate. And it also puts limitation on the kind of innovation that can be attracted, just simply because the ability to pay is not there. So then the fourth aspect is in terms of infrastructure. Now, the thing with venture capital is that venture capital mostly do not invest into R&D, in research and development kind of initiatives. So for venture capital, is more about commercializing innovation. So what innovation, technology innovation already exists? How can we commercialize it? Now, a lot of times commercialization, for it to be successful, depends on the sort of quality of infrastructure available. Right? For instance, for e-commerce to actually succeed, there has to be a good logistics system on ground. So when that underlying infrastructure is not there, it affects the performance of startups, which in turn affects venture capital, right? Then the fifth aspect is in terms of technical talent. Now, venture capital is one that moves in the direction of innovation. So what that means is that for a venture capital to exist, there has to be innovation to form. And innovation doesn't come out of the blue. Innovation is driven by people, right? And people that have necessary technical abilities to implement whatever innovation, whatever idea that they conceive. Now we've been seeing some growth in terms of distribution of technical talent, both in terms of software developers, technologists around. But then that also in itself is facing some challenges, because some of these technical talents are migrating to other developed countries in search of greener pastures, right? So that's one unique reality that we need to take into cognizance. And then the sixth aspect is a small number of local investors, that a bulk of the capital that, remember we talked about a class of individuals, limited partners that invest into venture capital firms. Yeah. Now a bulk of that those limited partners are foreign investors. So foreign investors account for the majority of capital that venture capital sees in the space, right? Local investors still forms a very, very small fragment. Now, there's this popular saying that says that who pays the piper calls the tune, right? So if much of the capital is coming from foreign individuals, to some extent, when certain economic reality starts deviating from their expectations, they leave. right? And that can affect the success of startups, like we saw in 2023, that a lot of there was a dip in terms of funding from about 6 billion in 2022 to 3.5 billion in 2023. And a large consequence of that is because some foreign investors had to pull out of the country because of some of the economic realities, right? Now, then the seventh part I'm just going to mention before I try to tie that together is underperforming capital markets. Right. Now, one thing we are going to realize is in terms of how venture capital exits their investment. So they exit their investment through acquisition by, let's say, a bigger player, or let's say an IPO where they list on a stock exchange and they're able to sell their shares and they exit. But then we have underperforming capital markets. As it stands, the only capital market in Africa that is more than $1 trillion is just the South Africa capital markets, right? The one that is following it is Casablanca, and that is a long distance second position of $60 billion. So we see that largely that the capital markets are underperforming in Africa to allow that sort of exit opportunities. So these are the realities that one needs to be aware of as in terms of how it affects venture capital. So now that will now lead me to tie it into, like I said, it is much about how these environmental realities affect certain outcomes that are critical to the operations of venture capital. Now, one of them is in terms of deal sourcing. Now, we talked about deal sourcing, and deal sourcing is something you find with VCs in Africa, and you find deal sourcing with VCs in the US. So deal sourcing is deal sourcing. But in terms of outcomes, now you now see that in terms of, let's say, the spread of the different kind of investment opportunities, and then also the quality of these investment opportunities, that one, because of the fact that there is low purchasing power, which means that certain innovation that maybe thrives in the US, if you bring it into Africa here, is going to fail, right? So that innovation cannot be able to find inroads into the market. So you now see more and more innovation are now concentrated in a few areas. Let's say, for instance, fintech, right? Almost every virtual, apart from VCs that are specialists and maybe they don't have fintech as their focus industry, they will have at least one fintech company in their portfolio, right? And you see them more concentrated in fintech, e-commerce, health tech, right? And then edtech here and there. So even within these sectors, the fintech or within health tech, you see that there's still this sort of concentration in a few niche within health tech, that most health tech startups are doing telemedicine and doing pharma tech, right? Because certain other adjacent aspects, like let's say biotechnology, that you typically find in the US, is struggling a lot when it comes to Africa, right? Because the necessary underlying infrastructure is not there. Right. So, for instance, 54 gene, part of the woes of 54 gene, right, was just also that infrastructure problem that it could not hack. Right. So you see that the sort of low purchasing power to attract certain innovation, and also the infrastructure gaps that we have to allow certain innovations to thrive. And then the third one I would also like to add is also the shortage of technical talent on certain innovation aspects. Like for somebody to be able to do biotechnology properly, the person has to have some sort of deep domain expertise within that particular field, right? And we see a shortage of that particular talent. So that now limits the spread and also the quality of innovation that we are having. So it affects deal sourcing for VCs in Africa, right? Then the second aspect now is in terms of investment. Now, you find that seed round, so the way venture funding for startup works is that it works in different stages, right? So we have pre-seed, we have seed, we have Series A, we have Series B, we have Series C. So these are the different stages when it comes to investment rounds for VCs.
Guys, you see, I told you were in good hands. We are halfway through our conversation. Join us next week for the second half, where we explore unique challenges in the African VC space, opportunities out there for aspiring venture capital professionals, and more. You won't want to miss it. See you next week, same time, same channel. And remember, the world of finance is for everyone to know. Adios. Bye-bye. Thank you for listening to the Libinance podcast. We'd love to hear from you on what you think, and do follow us on all our social media accounts and leave your feedback as always.